If you received federal relief to help cope during the pandemic, prepare for a tax bill. Not from the feds, but from the state. Officials say it all adds up to about $450 million in taxes for the state. Gina Mangieri is always investigating and explains the impact to businesses and individuals.
Recent COVID relief laws gave some recipients a break on some of the federal taxes associated with the money. But the state is not following the same rules, and that will hit many in the pocketbook. State taxpayers learned this week they won't have longer to file like the feds are allowing. With Hawaii taxes due in just a few weeks, individuals, businesses, and tax preparers are scrambling with huge key details still up in the air.
We kind of know what the federal rules are. We don't know what the state rules are because they're considered by the legislature right now.
Two big-ticket items are still pending, and they're likely to cost the unemployed more than $190 million. And businesses that needed a federal PPP rescue grant, they're probably on the hook for more than $250 million. Why? The state is not planning to follow certain tax exemptions and deductions that the IRS is allowing.
The federal government has a right to print money, and the state doesn't. We have to balance our budget. So every single time we give a tax benefit, like the non-taxability of UI or the deductibility of the PPP, the money has to come from somewhere.
Somewhere individuals and businesses will now have to look in their own pockets, with key legislation that would have given them a break likely dead for the session.
Currently, it's safe to assume that we will not be conforming or we will not be following the same type of relief that the federal government gave to residents.
A clause in the most recent federal rescue package has made legislatures across the country gun-shy of passing any more local tax breaks.
You cannot change pre-existing state tax laws to cut taxes, at least to offset that tax cut with this federal money. Our purpose was to make sure that the money that went to state and local governments actually got out there into the community in specific programs. And so we didn't want it used simply to reduce taxes or pay down deficits that had existed before COVID-19.
The unemployment insurance rate fix bill that staved off a massive hike on businesses was signed just before the latest federal act took effect. Meanwhile, there's still discussion about taxes on other relief.
If you got a grant, right, or some kind of rent relief or something like that, those type of subsidies that people got, right, is not taxable for state. But the things that are traditionally taxable for state are going to continue to be taxed, like unemployment.
As for the PPP, the grants themselves are non-taxable. It's whether businesses can also deduct expenses covered by the grant, where the feds and the state are diverging. Critics of writing off those receipts point out it's kind of a double dip.
You get the money tax-free, you spend it, you spend it, and you want to take the deduction again? No, it doesn't work that way.
Except this one time, and probably at the federal level only.
We've been telling people, hey, we're not going to conform. We're not going to conform. We're not going to conform. I don't want to be the Grim Reaper here, but there was enough clues there that people should have been aware that there was some tax consequences to this. It shouldn't have come as a surprise.
Gina Mangieri, KHON2 News, always investigating.